I want you to meet Richard, 68 years old, retired engineer out of Cincinnati, Ohio, 41 years at the same firm, drove the same Buick for 23 of those years, packed his lunch every single Tuesday because Linda made meatloaf on Mondays and the leftovers were sacred. Richard did everything right, and I mean everything. He maxed out his 401k every year since 1984. He took the company match. He rolled it over when he changed firms in 1997. He never panicked in the dot-com crash. He didn't sell in 2008. He didn't sell in March of 2020. He just kept feeding the machine, kept deferring the tax, kept doing exactly what the brokers told him to do, kept reading those glossy quarterly statements that said, "You're on track for retirement." Richard wakes up on the morning of his 73rd birthday. Linda made him pancakes. The grandkids are coming over later. He logs into his account and he sees the number, $1,240,000. He smiles. He thinks he won the game. He thinks he beat the system. He thinks 4 decades of discipline is about to pay off. He didn't beat anything. He walked into a trap that was set in the tax code and patiently, quietly, methodically waited for him to turn 73. And on this exact morning, the morning he thinks he finally won, the Internal Revenue Service is sliding a knife between his ribs. He doesn't feel it yet. He won't feel it until April of next year, when his CPA calls and says, "Richard, sit down. You owe the IRS $41,000. Medicare just raised your premiums by $2,000, and 85% of your Social Security check is now taxable income. And by the way, this is going to happen every single year for the rest of your life. And the amount they force you to pull out gets bigger every birthday, because the divisor in the IRS Uniform Lifetime Table shrinks every single year." That is a crime scene. That is the body on the floor, and nobody, not the broker, not the advisor at the bank, not a single person on financial television, nobody told Richard that his 73rd birthday was the day the IRS was going to break down the door and start taking inventory of the vault he spent 40 years filling. Welcome to Recession Warnings. This is the required minimum distribution, and I need you to understand what that actually means before we go one sentence further. The RMD is not a suggestion. It is not a guideline. It is a federally mandated, court-enforced, IRS-administered, mathematically engineered wealth extraction event. They calculate the exact amount they want pulled out of your account each year. They hand you a hard deadline of December 31st. And if you miss that deadline by a single day, one calendar day, one rotation of this planet, they hit you with a 25% excise tax penalty under the Secure Act 2.0 framework. 25% on top of the regular income tax you already owe on the forced withdrawal. Here is the part they don't advertise. The IRS doesn't want your money in 30 years. They don't want it in 20 years. They want it now. Specifically, now. At the exact age when you have the least flexibility, the least runway, and the least ability to fight back. As of today, the RMD age sits at 73, courtesy of Secure Act 2.0. It moves to 75 in 2033. But don't let that comfort you. All that means is the bomb is bigger when it finally goes off. There are 5 specific accounts that will trigger this detonation. And if you do not strategically drain, convert, or restructure them before your 73rd birthday, the math will not just hurt you. It will systematically dismantle the purchasing power you spent your entire working life constructing. Before we go any further, this is not financial advice. This is the conversation your broker was never incentivized to have with you. Now let's have it. Let's get into the math. The actual math the IRS uses. The math your advisor glossed over because his compliance department told him to keep it vague. Richard has $1 million in his traditional IRA. He turns 73 in 2026. The IRS Uniform Lifetime Table assigns age 73 a divisor of 26.5. 1 million divided by 26.5 gives you a required minimum distribution of approximately $37,736 in his very first RMD year. Now stop. Breathe. Because the damage hasn't even started yet. That $37,736 is not optional cash. It is not a bonus. It is forced ordinary income. It does not receive capital gains treatment. It does not receive qualified dividend treatment. It receives 0 preferential tax treatment of any kind. It gets stacked directly on top of every other dollar flowing onto Richard's Form 1040. Here is what Richard's income picture looked like the day before the RMD landed. Pension from his old employer, $34,000. Social Security benefits, $38,400, claimed at full retirement age. Interest from CDs, $12,000. His pre-RMD income line sits at $84,400. Manageable. He believed he was in the 12% federal bracket. He thought he was fine. Then the RMD lands. $37,736 of forced income slams onto the return. His gross climbs to $122,136. He is now in the 22% bracket and bleeding into the 24% bracket on the top slice. But that is just the opening act. The IRS has two more knives, and they were already drawn. The first hidden knife is the Social Security provisional income trap. The thresholds for taxing Social Security benefits were set in 1983 and 1993 and have never, not once in over 4 decades, been adjusted for inflation. That is not an oversight. That is a feature. It is a stealth tax that grows more punishing with every year of inflation. Once your provisional income crosses $34,000 as a single filer, or $44,000 married filing jointly, up to 85% of your Social Security benefits become taxable ordinary income. Richard's RMD vaporized that threshold. Now $32,640 of his $38,400 Social Security check, 85% of it, is suddenly taxable. Income that was completely untaxed the morning before his birthday. That is knife number 2. The third knife is IRMAA, the income-related monthly adjustment amount. This is the Medicare premium surcharge that hits higher income retirees. And here is the most brutal part of the whole architecture. IRMAA does not operate on a ramp. It operates on a cliff. You can exceed the threshold by $1 single, and your Medicare Part B and Part D premiums for the entire following year jump by hundreds, sometimes over $1,000. There is no proration. There is no soft landing. It is a binary, mechanical, mathematical guillotine. For 2026, the first IRMAA cliff for a married couple triggers around $218,000 of modified adjusted gross income. Richard and Linda, combining her smaller pension and Social Security with his, are sitting right at the edge of that cliff. The RMD shoves them over. Their combined Medicare premiums jump by roughly $2,100 for the year. Now let's add the full damage. Federal income tax on the RMD itself, roughly $9,000. Federal tax on the newly exposed Social Security income, roughly $4,200. IRMAA Medicare surcharge, roughly $2,100. State income tax, roughly $1,400. Total tax cost of Richard's very first RMD, approximately $16,700. He withdrew $37,736. He kept about $21,000 of it. 44 cents of every forced dollar evaporated into the tax machine. And this happens every single year for the rest of his life, with the divisor shrinking at every birthday. 26.5 at 73, 25.5 at 74, 24.6 at 75. The percentage being extracted climbs every year like a fever that never breaks. That should make you furious. Drop a comment right now. How old are you, and what percentage of your liquid net worth is sitting in a traditional tax-deferred IRA or 401k? I read every comment. I want to see exactly how many of you are walking into Richard's trap right now. Are you 64 with 80% of your savings deferred? You are already in the kill zone. Are you 71 and you have never done a single Roth conversion? You have 2 harvest years left before the gate slams. Tell me, we are going to triage this together. Now, the critical thing to understand is that this was not an accident. The 401k was designed to defer your tax bill, not eliminate it. The government always understood that compounding works in both directions. Your account balance grows, yes, but so does the government's eventual claim on it. When you deferred $20,000 at age 35 in the 22% bracket, you saved $4,400 in taxes that year. You felt smart. But that $20,000 grew for 38 years into roughly $200,000. And at 73, when the RMD machine pulls it out at a combined effective rate of 35 to 40%, you saved $4,400, and they will collect $70,000 to $80,000. That is a 17-to-1 tax arbitrage in favor of the government. That is not a retirement plan. That is a layaway account for the IRS. And the 25% excise penalty under Secure Act 2.0 is the closing fee. If you are required to take an RMD of $37,736 and December 31st passes without that withdrawal hitting your bank, because you were on a cruise, because your custodian sent the notice to an old email address, because your wife was in the hospital and taxes were the last thing on your mind, the IRS assesses a 25% excise tax on the missed amount. That is $9,434 in penalty on top of the regular income tax you still owe when you eventually take the distribution. You can appeal it down to 10% if you file Form 5329 with a reasonable cause statement within 2 years, if they accept it, at the discretion of the same agency that built the trap. Send this video to one retiree you care about right now, not tomorrow, today. One parent, one neighbor, one friend who is proudly letting their savings compound untouched because their advisor told them to stay the course. One share may save them $75,000 in stealth taxes over the next decade. That is not an exaggeration. That is the math. The reason no one in mainstream financial media runs this story is simple. The entire wealth management industry, $15 trillion of assets under management, is built on the premise of deferral. Deferral generates fees. Deferral generates quarterly review meetings where the advisor charges his 1%. The day you start strategically draining your IRA is the day his fee base starts shrinking. He is not structurally on your side. The incentives point in the wrong direction. Now let's talk about what you actually do about it. There are 5 accounts, 5 specific vehicles that will generate this detonation at 73 if you ignore them. And for each one, there is a specific window, a specific strategy, and a specific sequence. Let's go through all 5. Account number 1, the overfunded traditional 401k. This is the primary detonator, the atomic bomb in the basement. If you have a traditional pre-tax 401k and your balance is north of $500,000 by your early 60s, you are mathematically guaranteed to walk into the RMD trap unless you intervene before the clock runs out. Here is what the intervention looks like. The window between when you retire and when RMDs begin, typically somewhere between age 62 and 73, is the single most valuable tax planning period in your entire financial life. It is the only stretch where you have low or zero earned income, full control over how much you withdraw, years before Social Security must be claimed, and years before distributions are forced. You use this window to execute what is called a systematic Roth conversion ladder. You move controlled chunks of the traditional 401k, typically $40,000 to $80,000 per year, calibrated precisely to fill up the 12% and 22% federal brackets without spilling into the 24% bracket, directly into a Roth IRA. You pay the tax now, voluntarily, at a known rate on a known amount in a known year, and you transfer that money into a vehicle that will never carry an RMD, will never generate taxable income in retirement, and will never trigger a Social Security tax cascade or an IRMAA cliff. This is not a trick. It is the legal window the tax code built into its own architecture, and the brokerage industry has no financial incentive to point it out to you. Your state of residence dramatically changes the math on these conversions. States with zero income tax, Florida, Texas, Nevada, allow you to run the ladder more aggressively. High-tax states will eat into the conversion economics. Know your state's rate before you build the schedule. Account number 2, the forgotten rollover IRA. This is the silent killer. The account most retirees barely think about because it was assembled passively across decades of job changes. You left a job in 1991 and rolled the 401k into an IRA. You left another in 2003 and rolled that one in too, then again in 2014. Now you have a $700 rollover IRA at your brokerage that you glance at twice a year. Every single dollar in that account is pre-tax. Every single dollar hits your Form 1040 as ordinary income the moment it is distributed. And here is the hidden penalty most brokers never mention. The rollover IRA is aggregated with all your other traditional IRAs for RMD calculation purposes. You cannot treat them separately. The IRS adds them together, applies the divisor to the combined total, and issues the mandate on the full amount. The conversion strategy here is identical to the 401k ladder, with one critical addition: the pro-rata rule. If you have any pre-tax money sitting in any traditional IRA when you attempt a backdoor Roth conversion using after-tax basis, the IRS forces you to treat that conversion proportionally across all your IRAs simultaneously. Think of it this way. It is the cream in your coffee rule. Once the cream is mixed in, you cannot scoop out only the cream. Before you execute any backdoor Roth strategy, the rollover IRA must be either fully converted, fully drained, or in certain cases, rolled back into an active employer 401k plan that accepts incoming rollovers, to remove it entirely from the pro-rata calculation. If you skip this step, the backdoor Roth strategy you think you are running cleanly is actually creating a taxable event you did not intend. Get a fee-only CPA, not one who gets commissions from the products he recommends, to map this out for your specific state and account structure before you move a single dollar. Account number 3, the inherited non-spousal IRA. This is where the Secure Act delivered its most precise cruelty. Before 2020, if you inherited an IRA from someone other than your spouse, typically a parent, you could stretch the distributions across your own life expectancy. Small annual withdrawals, tax efficient, manageable. That ended. The Secure Act of 2019, applied to all deaths on or after January 1, 2020, demolished the stretch IRA entirely. Non-spousal beneficiaries must now fully drain the inherited IRA within 10 years of the original owner's death. No exceptions, no extensions. And after years of regulatory confusion, the IRS finalized rules in 2024, clarifying that if the original owner had already begun taking their own RMDs at the time of death, the beneficiary must take annual minimum distributions during years 1 through 9, and then zero out the entire remaining balance by year 10. You cannot simply let it sit for a decade and take the whole thing in year 10. That move will vaporize nearly a third of the inheritance in a single tax year. Here is what the catastrophic version of this looks like in practice. You inherited a $400,000 IRA from your father in 2022. You have until December 31, 2032 to empty it completely. You are currently 65 years old, working part-time at $50,000 per year, already collecting Social Security, and trying to run Roth conversions on your own account simultaneously. You are now stacking inherited IRA distributions on top of part-time wages, on top of Social Security income, on top of your own conversion activity. You have built a personal tax catastrophe without realizing it, and it is entirely avoidable with the right sequencing. The strategy is straightforward. Front-load the inherited distributions during your lowest income years. If you are in your early 60s, not yet drawing Social Security, and your earned income is minimal, take large distributions from the inherited IRA at the 12% bracket now. Spread the damage across the full 10 years intentionally. Do not let it accumulate until year 10. A year 10 mass liquidation at your peak income age is the single most efficient way to hand a third of your father's savings to the government. Account number 4. Variable annuities held inside a qualified account. This one is the most infuriating item on this list because it is entirely a product of commission-driven advice. A variable annuity is an insurance product wrapped around a portfolio of mutual fund subaccounts. Its primary selling feature is tax deferral. The funds grow without generating annual taxable income inside the annuity wrapper. In a taxable brokerage account, that deferral has genuine value. But somehow, and this happens constantly across America, retirees end up holding variable annuities inside their IRA or 401k. The broker recommended it, the advisor sold it, and now the annuity is sitting inside an account that is already tax-deferred by definition. You have wrapped a tax-deferred product inside a tax-deferred account. You receive zero additional tax benefit from the annuity wrapper. What you do receive is a fee structure that would make your head spin. Mortality and expense charges around 1.25% per year, subaccount fees averaging 0.85%, rider fees running another 1.1%, a total annual drag of approximately 3.2% on your money every single year for a tax benefit that costs you nothing inside the IRA to begin with. This is not a financial product. It is a commission vehicle. Brokers earn 5 to 7% upfront on variable annuity sales. That is why they exist inside IRAs. That is the only reason. The strategy before age 73 is to get out. Check your surrender schedule carefully. Most variable annuities carry a declining surrender charge of 7, 6, 5, 4, 3, 2, 1% over 7 years. And if you are several years into the contract, you may already be past the worst of the penalty curve. Calculate the total cost of surrendering now versus the ongoing drag of holding the annuity for another decade. In most cases, the math heavily favors surrendering, eating the remaining charge if any exists, and moving the capital into a low-cost index fund inside the same IRA. You stop paying 3.2% per year in fees for nothing and immediately begin compounding on a clean, low-cost structure. Account number 5. The after-tax brokerage account you have been ignoring in favor of the tax-deferred accounts. Most retirees approaching 73 have the majority of their liquid wealth sitting in tax-deferred accounts, traditional IRAs, 401ks, rollover IRAs, and a relatively small after-tax brokerage account that they treat as secondary. This sequencing is backwards from an RMD management perspective. Here is what the after-tax brokerage account actually gives you that none of the tax-deferred accounts can. Long-term capital gains treatment at 0%, 15%, or 20% depending on your income level. Qualified dividend income at preferential rates. No RMD requirements. Ever. Step up in cost basis at death, meaning your heirs may inherit appreciated assets with zero capital gains liability on the embedded gain. The strategic move, in the years before RMDs begin, is to deliberately deplete the tax-deferred accounts through Roth conversions and intentional withdrawals, and preserve the after-tax brokerage account as long as possible. The brokerage account generates income at preferential tax rates that do not stack on your ordinary income the way IRA distributions do. It does not trigger the Social Security taxation cascade. It does not push you over IRMAA cliffs. For retirees with significant after-tax assets, the sequencing strategy, spend the tax-deferred accounts first through controlled conversions, let the brokerage account continue compounding at favorable rates, can reduce lifetime tax liability by 6 figures over a 20-year retirement. Now let's bring this back to Richard, because Richard is not a story. Richard is a template. He is every American who did exactly what the financial industry told him to do for 4 decades and arrived at the finish line to discover that the prize was a bill. The required minimum distribution system is not going away. The IRMAA surcharge is not going away. The Social Security provisional income trap is not going away. These are features of the tax architecture, not bugs, and they have been compounding in the government's favor since the day you made your first 401k contribution. What is going away is your window to act. At 62, you have 11 years of harvest time before 73. At 67, you have 6. At 71, you have 2 years before the gate closes. Every year you do not run a Roth conversion is a year you are leaving the tax rate selection entirely to the IRS, and they will not select a rate that favors you. The 5 accounts we covered today are the 5 detonation points: the overfunded traditional 401k, the forgotten rollover IRA, the inherited non-spousal IRA under the 10-year rule, the variable annuity sitting uselessly inside your tax-deferred account, and the after-tax brokerage account being systematically neglected while the tax-deferred bomb grows larger every year. Every single one of these has a window. Every single one has a strategy. And every single one of those windows is closing on a fixed calendar that does not care whether you were paying attention. This is Recession Warnings. If this video gave you one number you did not know, one strategy you had not considered, one reason to open a conversation with a fee-only CPA before your next birthday, share it with one person today. One parent, one friend, one neighbor who is still on cruise control with a $600,000 IRA and no conversion plan. The math in this video is not hypothetical. It is running right now on the accounts of millions of Americans who were told to just stay the course. The course leads directly into the RMD trap. You now know where the trap is. What you do next is entirely up to you.